You're tuning into the Real Estate Diversification Podcast, hosted by trusted and experienced real estate attorneys who are also seasoned real estate investors themselves. Are you ready to explore unique real estate investing opportunities? Ready to learn about emerging trends and new ideas? Your hosts will help you understand the practical and legal complexities of a myriad of real estate investments so that you can maximize your potential and achieve financial freedom. Now, listen in and get ready to learn.
Welcome back, Red Podcast Nation. Ferd Niemann here again, today, another episode of the Red Podcast, the Real Estate Diversification Podcast. Today, I'm going to talk to you about a topic that's pretty common when you think about real estate investing. It's multifamily investing. Multifamily, it's pretty much what it sounds like, right? It's real estate investing, but instead of single family, it's multifamily. So that means two, duplex. Congratulations, you bought a duplex, you're a multifamily investor. You are. That's great. Obviously, you can buy a 4-plex, an 8-plex, 16-plex, or 1,000-complex compound. Lots of pros and cons of each, but ultimately, you got to figure out what's right for you, what you want to invest in. I mean, real estate in general, I've talked about this before, has the opportunity for cash flow, appreciation, debt pay down. Multifamily real estate investing, it's pretty competitive. That would be one of the cons, but one of the pros is it's pretty known, right? It's a proven concept of wealth. So I'm a fan of multifamily. I sometimes talk about other asset classes like mobile home parks, and I kind of throw some shade at mobile home park at multifamily. But overall, I like multifamily as well. I actually started in single family, then I did duplexes, and now I invest in several multifamily projects, mostly as a limited partner. But you can invest in multifamily as an owner operator, or you can hire third-party professional management. So you need to figure out what's the most attractive option to you. It can create long-term wealth, also current term income. Like any investment, there are risks and there's also opportunities. I would say some of the pros, if you will, of multifamily investing is you can really have steady cash flow because it generally comes in scale. If you got a 64 unit apartment complex and you got 2, 3, 5 vacant, you're probably doing just fine as far as cash flow. Obviously, you want to be at maximum occupancy and you want to have your rents at market. Apartments have a lot of turnover, which can be a con. But one of the pros is you get to reset the rental price to market. So in the current time period we're in, this is March of 2023, we're in a very inflationary environment right now. Well, apartments are a good hedge against inflation generally because somebody moves out, you just increase the rent for the next person. And somebody doesn't move out, you just increase the rent. What are they gonna do? Move across the street? The rent's the same, right? A con is that people can still build apartments. Cities don't mind these. They're generally pretty good at property tax revenue because they're expensive. One of the cons of owning existing multifamily is somebody can build one and it's gonna be a newer, fancier product. Now, one of the pros is they probably have a higher cost per door. Sometimes some of the apartments are valued based on a per door price or per unit price. People also look at a cap rate. Cap rates typically are pretty low on multifamily apartments. And part of that's because one of the huge pros is economies of scale. And if you have one rental house and you increase the rent $1, it's $1. Okay, if you increase the rent $100, it's only $100. But if you have 100 units, hey, now we're starting to talk about real numbers. You can really increase it. And then also, if you have one go vacant and you only own a duplex, that hurts. If you have 100 units, if one goes vacant, doesn't hurt, right? So the pros would include these economies of scale. Also, if you've got a 8-plex, you might have one roof, right? So that roof the cost is spread out amongst 8 units. You might have one parking area with 8 or 16 stalls. You don't have a yard on all 4 sides. So there's just generally some real economies of scale, and that makes the assets just more desirable, more institutional grade. So it allows for better financing, better leverage. You can get some really aggressive debt on multifamily properties, including short-term debt like bridge loans or mezzanine debt. You could always get private lenders, I'm sure, as well, but you also can get agency debt, which is Fannie Mae, Freddie Mac, long-term, long amortization, long-term fixed rate, sometimes interest only, lower rate, non-recourse. So that's something that multifamily really has over, I think, any other asset class is better debt. And if you have good debt, you can generally lever it up more, have positive leverage and positive arbitrage will be when your cap rate. So you buy it at a 6 cap and your interest rate on the debt is 4%. That's positive arbitrage. Then also you can borrow sometimes 80% of the purchase price. Well, then those dollars of equity can be leveraged more. Well, because of the scale, if you increase the top line revenue, ideally it's going to increase the bottom line net operating income many multiples. So that really leads to appreciation and additional cash flow. And because multifamily has a lot of debt on it, there's a lot of opportunity to have your tenants pay down your debt. I think multifamily is pretty liquid too, more so than a lot of other real property. Now, obviously, stocks and bonds in most instances are going to be very liquid. Cash, very liquid. But as far as real property, one of the negative elements, if there are any, and there are some, taxes. But one of the negative elements of real property is going to be that it's illiquid. Multifamily is generally more liquid. There's also multifamily in nearly every market, so that's really helpful. And most real estate does have positive tax benefits. Multifamily is right there, where it does have depreciation. You can write off management expenses. You can write off operational expenses like taxes, insurance, and then you get the paper losses of depreciation, including bonus depreciation, which is enhanced by cost segregation studies, which is further enhanced if you are a real estate professional. I got a whole nother blog topic on that you can check out. Just go to diversificationpodcast.com and you'll see our blog section. And I've got more detail on how that can benefit all real estate investments. But overall, multifamily, it's just kind of steady Eddie cash flow. It can be good. Some of the cons is it can be a management challenge. Now you can reverse that into a pro and you can hire a third-party property manager, whereas some asset classes you really can't do that. If you own 2 single-family houses, it's kind of hard to get a property manager because of scale. If you own mobile home parks, it's really hard to get good third-party management. There's not very many in the country because it's can be more management intensive and more of a niche skill. Other assets like triple net retail, there's really not as much to manage. It's generally not worth paying as much to manage those. But multifamily, if you manage them yourself, there's a lot of tenants and a lot of units. It's a lot of. I had one lady, I used to do retail with her, and she said, "I don't do multifamily." I said, "Why not?" She said, "I don't like toilets." She goes, "I don't want to have 500 toilets." And in theory, they all break at midnight on Christmas Eve, but in reality, it probably doesn't. People have been landlords since the beginning of time, and it's been a pretty good profession. So that can be a con, but I think you can spin it as a positive as well. One of the cons is just kind of the upfront cash. I mean, to get in the game, multifamily, it takes some money. I mean, if you're supposed to talk about bigger multifamily, if I want to go buy 50 units of multifamily, I mean, in a lot of places right now, it's going to be 175,000 a door, 50 units. That's 8.75 million. I mean, good grief. I've bought 50 unit mobile home parks for $520,000, right? But it's all a function of the net operating income. The benefit of an apartment is people pay the top line revenue, which is gross revenue of the whole unit, versus a mobile home park. Maybe they own their own house. They only pay you for the land rent. Single family, there's a lot of competition. People can buy single family a lot easier. Multifamily, you get them in some really nice areas, like downtown Kansas City has really high end multifamily, $2 a square foot. There's also multifamily that I'm an investor in one, it's 85 cents a square foot. And some of those even has subsidies that require it in rent control. So that can be, it's not rent control in the sense of government imposed on all multifamily, but that does exist in some places. But sometimes multifamily properties are, especially new construction, are built using some form of tax incentives, and the cities may often put in some sort of requirement for an affordable housing quota to allow disadvantaged people to have access to housing in premier locations. But generally, multifamily can be expensive, and it's really competitive. When I left, I left the single family space, and I looked at multifamily. I'm like, I need economies of scale. I need more cash flow. I need better debt. Oh wait, everybody else already figured this out. And I realized it was very competitive. So there was very sophisticated, very well capitalized players. And in some markets, it's very consolidated already. So that can be a con. So I skipped multifamily and I jumped into mobile home parks, which I'll cover in a different episode here. But overall, the upfront investment's the con. Another con would be market volatility. When you rely on debt, like multifamily often does, interest rates come up and down. I have a guy I'm working with recently bought it's like a $40 million property, and obviously a lot of units, and he decided to buy it with short-term debt, 2-year loan. And then the theory being he was going to push the rents, decrease expenses, push the NOI, refinance, get it on permanent debt, probably at that point Freddie Mac debt. After 2 years, and he'd have all this built up equity. He could pay off his investors, and he could then ride in the sunset forever. Well, here's what happened: 2022 interest rates carried into 2023. Rates have gone up well over 200 basis points. Some loans 300 basis points, and it really shrank his ability to refinance because his debt coverage ratio on the higher interest rate made it infeasible to maintain or increase the leverage. So really puts a chokehold on some of the properties. So there is market volatility. And if somebody builds a new shiny project, they may get the next tenant. Well, you could have vacancy and you could have lower rents. Also, just building multifamily has a lot of regulation. Generally, you need to get building permits, but you also need to go through the zoning process, perhaps rezone. Well, if you are next to residential, single family, the neighborhood's going to hate you, right? So you got to go through the rezoning. Somebody's got to change the master plan. Somebody have to change the code. You have to go through the preliminary development approval process and the final development approval process. You have to plat the property. You need to hire an architect, an engineer, attorney, generally other surveyor, design people to help with city design guidelines, et cetera. So multifamily is not for the faint of heart, but it is also one of the best real estate investments out there. But it's not the most unique, because it's kind of well known. There is a unique opportunity that you can add value relatively quickly by increasing your finishes, increase rents. You can turn over units. You can add amenities. You can change the size and the layout. You could do a mix. Studio apartment, 1 bedrooms, 2 bedrooms, 3 bedrooms, 4 bedrooms, etc. There are kind of garden style apartments. There are sky rises. There are block buildings. A lot of times here in Kansas City, people try to build 3 stories, quote, stick build. If you go 4 stories, you typically have to have an elevator. Well, if you have an elevator, then you have the elevator's union. And sometimes you need steel or other concrete or other materials that are more expensive. So people try to keep them smaller and then arrange the parking in a way that also reduces the need for parking and so on. So that's a unique opportunity, is to add value. And then just a unique opportunity is that you can really push for higher returns because of the things I mentioned. Excuse me. So you can have higher returns because of the economies of scale, so value add, compared to a lot of other asset classes. Unique risks. I mean, what if your tenants, move out in bulk because they go to a new place? What if there's I saw recently like a water issue at one of the communities, apartment communities, and a bunch of people left at once. So there are some tenant risks. Tenants, anytime you have tenants, they can violate lease agreements. They can, you could get, 1 or 2 or 3 people in a drug ring, and then it could wipe out the whole floor, the whole building. So there's some exposure there when you have people right on top of each other. Apartments, there's not a lot of privacy. Look at what happened in COVID, right at the beginning of COVID. People started wanting to move to the suburbs a little bit more because downtown wasn't really happening. The restaurants, the bars, the nightlife wasn't open, and I'm stuck in my little bitty apartment. Apartment units are generally going to be smaller per dollar, right? So higher per square foot cost. So that's a unique risk if people decide they don't want to pay that anymore. And during some of the COVID restrictions, you couldn't even get on the elevator with anybody else. So it really made the fun of common area apartment living. It made it a unique risk that happened when we had social distancing. So that's an operational risk. And in general, you have all the other risks of collections and evictions and all that kind of jazz. But overall, multifamily is a tried and true asset class. I recommend it. I generally do it as an LP, limited partner, which generally would be there's an operator who's the managing partner or sponsor or syndicator. And I will invest, if I invest $50,000, for example, I may get an 8% preferred return. So in that example, it's $4,000 a year. I get the first $4,000, me and my other limited partners. If there's additional money, then the general partner gets some money. And if it's a 30-70 split, the general partner gets 30%. Thereafter, me and the other LPs get 70%. Typically, the sponsor will take an acquisition fee or an asset management fee, perhaps, which could be based on assets under management or equity under management. And then they'll also take property management fees, whether they self-manage or if they outsource management to a third party. But for me, then it becomes a passive investment. So that's my preferred. I do like investing in apartments, but I typically do it as a passive investment because I don't want to actively manage them. And it's harder to scale, at least with higher yield, because there's so much competition. Now you can scale in one fell swoop. I know a couple of guys that bought 200 units in their first park or their first community. And then some guys bought 1,000 units in the same city in their first year. Okay, so it's possible, but not sure that they paid the right price because they outbid everybody else in the marketplace, more seasoned. It's less common for multifamily to be purchased off market because they're high dollars. So brokers care, right? Brokers will call. If you own a multifamily property, brokers are going to find you and they're going to try to list your property. So that's good for you if you want to sell. But if I'm trying to buy in the industry, it's hard to find a bargain because of it. So not that they're not there, multifamily duplexes and fourplexes are more for your entry level and smaller players. And I used to do duplexes and did fine with them. I just wanted to give a little more of the upside. So I pursued multifamily, which then led me into mobile home parks as a alternative to the standard site-built multifamily. So lots of good stuff when you're looking at multifamily, pros and cons, like anything. So invest wisely. Until next time, thanks and God bless.
Thanks for listening to the Real Estate Diversification Podcast. Did you enjoy the episode? Visit www.rediversification.com to tune in to more exciting episodes and free information and tools that will help you succeed. Leave us a review and subscribe to us on Apple Podcasts and our other social media channels at the RED Podcast. Thank you for listening, and we'll see you next time. Missouri Bar Advertising Disclosure. Neither the Supreme Court of Missouri nor the Missouri Bar reviews nor approves certifying organizations or specialist designations. The choice of a lawyer is an important decision and should not be based solely upon advertisements.